Cisco Systems Inc. is currently trading at $51.97 a share. It is a favorite among dividend investors for its 3.8% dividend yield. Now, is this the right time to buy the stock with all the hype in AI? Well, we will have a look at that right now. So what we're going to be doing is looking at my automated stock valuation spreadsheet, then looking at my discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value to see if Cisco is a buy or a sell. Now, over the last year, it is down 3%, and if we even go to the last 5 years, it has been pretty volatile, up highs of 62, lows of around about $35 a share, but overall up about 5%. Now, this is a favorite, as I said, with its massive dividend yield. Now, let's have a look at the company financials. So, if we go to my automated sheet and type in Cisco's ticker, what this will do is it'll load all of the latest company financial data so we can have a deeper dive. 207 billion market cap, PE of 20.46, and with a market average of 29, that is lower than the market average, which is good to see. Earnings per share, $2.54, and a beta of 0.83, meaning it is less volatile than the market, which is why it is a favorite for dividend investors. Target price of $55 a share. So analysts are saying it is a buy. And more about this dividend here, $1.60 a share, and it's a safe dividend with 6.4 billion being about 60% in terms of net income and free cash flow payout ratio. If we have a look at Dividend Max here and type in the ticker, Cisco, this will show us when you should buy those shares. So if you buy them before October 2nd, you will get paid that lovely dividend. So let's have a look at revenue here. Revenue, $53 billion or 53.86 billion in the trailing 12 months. Not the all-time high that was in 2023, but you can see they are steadily increasing their revenue. Is net income a similar story? Well, yes and no. It is a very profitable company with about 10.32 billion, but down from its all-time highs in 2023. Now we're looking at free cash flow, down to about 10.12 billion again here. As we saw before, the free cash flow and payout ratios are pretty similar because the numbers are pretty close. But you can see here that it is down slightly in the more recent years. Shares outstanding, what are they doing? Well, they are consistently buying back their shares, which means they are rewarding shareholders, because if you own one share and there's 10, you would own 10%. If they buy back 5 of those shares, you would own 20%, so you would own more of the company's profits. So let's have a look at my discounted free cash flow model. This is a way of valuing a company using its expected future free cash flows. And you can see here, based on the averages, it is a buy with $84 a share. Now let's have a deeper look here and see if we agree with these numbers. If we go to analyst estimates on revenue, analysts are expecting around about 56 and 58 billion. And growth of around about 4.3% per annum. So let's crank this up a little bit, 4%. So that's about what they're saying. $91 stock. Net income margins, we'll take an average of the most recent years, which is around about 18.6%. So that will bring the price down slightly. $80 stock. And in terms of the net income to free cash flow, let's go a bit of a bearish case there, even at $100. So it still is a buy at 62. So that is good to see. But if we look at the sort of most recent year, you can see it is a buy at 80. So discounted free cash flow does like the stock. Dividend discount model. This rates it at if they can continue growing the dividend. Now, yes, this is a bit on the higher side of 4.5 growth, but it does have it at about $54. So this is good to see that it is a buy on dividend discount model. We'll quickly look at the Ben Graham formula for intrinsic value first. This is created by Ben Graham, and we saw that analyst growth is around about 4%. So if I put 4% in here, not a buy. It would have to be somewhere in the region of about 15 to 20% growth, which is a bit on the high side. So Ben Graham does not like the stock, but the reason why I like this is because of the comparable company model. So if you're interested, please check out my Patreon. Links are in the description. But if we were to look at the comparable companies model, now this is a way of valuing companies looking at similar companies in similar industries. And I'm actually going to look at 2 different types. The first one we're going to look sort of more closely, which is Oracle, Dell, and HPE. And now what this will do is it'll load up all the latest company financial data. and we can compare against these looking at revenues, profits, EV to revenue, EV to EBITDA, and PE. So in terms of revenue, they are growing, which can only be said for Oracle. Dell and HPE are down. Profit margins very high, 20% for Oracle and Cisco compared to the 5 and 6% of Dell and HP. Price to sales, price to book. You can see it's actually in the middle of the pack towards the lower end, which is good. Price to sales, a bit on the higher side. Sorry, PEG, which is Peter Lynch's price to earnings growth. Dell is actually the lowest, so it might be interesting to look at that stock, but they are middle of the pack once again. But EV to revenue, EV to EBITDA, and PE, if we take averages of these, it does put it at around about a $54 stock, which is, looking at the current price, a slight buy. Now, the one I wanted to look at as a comparison is if we do Google, Microsoft, and Amazon, who are, I would say, similar as well, but obviously a lot bigger. Where would this be valued in terms of our valuation here? Yeah, see, that would put it somewhere in the region of a $60 to $80 stock, meaning it is about a $77 stock here. Obviously, those profit margins are a lot higher for Google and Microsoft. The ratios are a lot lower. This is the lowest PE, which is why it is the highest with $82 a share. But pretty good on the other valuations as well. So that's the thing. It does look a pretty good stock, and obviously you're getting that 3% dividend. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Check out my Patreon if you're interested as well. And I will catch you guys next time.